Okay, thank you for coming back this afternoon. There's a number of issues we're going to have a look at. The first of which is segmental reporting. FTMS has a business in Malaysia. FTMS has a business in Singapore. FTMS has a business in Hong Kong. If you were an investor in FTMS, or you were thinking of buying shares in FTMS, you might want to know whether FTMS got its profits, got its revenue 80% from Malaysia and 10% from Hong Kong or 10% from Singapore, or 80% in Hong Kong. You would be interested to know the distribution within the group as to where the profits were being made. Because you may have a view that you don't like Hong Kong, or you think Hong Kong's too risky. Or you might have a view that, Singapore's too mature and that the opportunities are in Malaysia. So if the business is primarily Malaysian, you're interested in buying the shares. But if the business is 15% Malaysia, 50%, 35% elsewhere, you don't want your investment to be made. The simple point that I'm trying to make is this. When you look at a set of group accounts, it's aggregated. When you look at a set of financial statements, they are a total of the performance, the total revenue, the total costs, the total profit. And underlying that, the business could be operating in country A, B, C, D, could be operating in different geographical regions, or could be operating product A, product B, product C, and product D. And different products and different countries have different risks, have different returns, have different performances, and are of interest to different investors. Segmental reporting. It's all about disclosure. It's all about disaggregation. It's all about breaking down the figures that are in the accounts and then showing in a note to the accounts how much is in Malaysia, how much is in Singapore, how much is in Hong Kong, how much is product A, how much is product B, how much is product C. That's the big picture. I'll repeat this at the end, but basically I think it's a waste of time. It's not an accounting standard which I place a great deal. A segmental report is not a piece of information that I would place an enormous weight on, because the management have so much discretion in deciding what is a segment, what is a segment profit, transfer pricing, so on and so forth. So it's very easy to manipulate the segmental report, and the segmental reports are not really comparable, because different companies will define their segments in different ways, and even a company over time may reorganize the way that it operates. So I think it's of limited value. The examiner's gone on record as saying you will not have to prepare a segmental report. So the segmental report, the numbers, that's done on a spreadsheet, that's done by the management accountant, that's not done by you. So we are not going to physically prepare a segmental report. Secondly, we are not going to actually interpret a segmental report. But we have to be aware of segmental reporting, and it's from a theoretical basis. So let's think about what the objective is, let's think about what the definition is, let's think about how we identify a segment. Basically, the objective of a segmental report is to help the users better understand, to help the users better appreciate where the profits and assets are. Are they in country A or country B? Are they in product A or in product B? A segment is a component of the business that trades, that functions as a business, whose results will be overseen by the chief operating decision maker. So the idea of a segmental report is that it is, in essence, management accounts. How does the group run the business? Is there a director for Malaysia, a director from Hong Kong, a director from Singapore, and those directors are making decisions? If that is the case, then the segments are geographical. But if there is an ACCA director, a degree director, a publishing director, and those product lines are the way that business decisions are made, the chief operating decision maker reviews products rather than territories, then the segmental report is produced along product lines. It all depends how the chief operating decision maker is looking at the financial accounts. In substance, segmental reporting is management accounts, because you are looking through the eyes of management, you're looking through how the business is being run. That's the theory anyway. Yeah. No debits, no credits, no numbers, no interpretation, but we do have a purpose, we do have a definition, we do have a little bit of application that we can see. And it will be nice to see a past exam question, just so we can say that we've looked at it. So, purpose. The purpose of segmental reporting is to enable the users to better understand. To enable the users to better understand the nature and financial effects, the nature and the financial effects of the business activities and economic environments. We live in an aggregated world. The profit and loss account is aggregated. It is one number for turnover. But where is that turnover generated? A, B, C, or D? So if you break it down in the segmental report, you help the users understand where the economic activity is, where things are happening. We can define a segment. A segment is a component of the business. That engages in business activities. That engages in business activities. It has revenues. It is active. It is not a pension fund. It is not a boring head office. It does something. Engages in business activities. Whose results are reviewed by the chief operating decision maker. CODMA. So the components of it's a component of the business that engages in business activities whose results are reviewed by the chief operating decision maker. And for whom financial information is available. Well, of course financial information is available. If the boss is looking at the information to make decisions, of course the information is available. So that is what a segment is. A component of the business that engages in an activity whose results are reviewed by the chief operating decision maker. Now, you make a disclosure of the revenue, you make a disclosure of the profit or loss, and you make a disclosure of the assets and liabilities. So you make a disclosure of the revenue of each segment, the profit or loss of each segment, and the assets and liabilities of each segment. So you gain, from a user's perspective, an understanding as to where the engine of the business is to be found. Where are the resources to be found? Where are the profits to be found? Are we a Malaysian business with a little bit of Hong Kong and Singapore, or are we a Singapore business with a little bit of Malaysia and a little bit of Hong Kong? Because a lot of companies are conglomerates, a lot of companies are a collection of different activities. Revenue, profit or loss, assets, liabilities. Now we're looking at the results which are reviewed by the chief operating decision maker, the boss, the director. Now when a director is looking at information to make decisions, they don't ask me. I'm a financial accountant. So what I do is I keep the accounting records and I prepare the financial accounts at the end of the year that look back and say what has happened. There's a whole branch of financial reporting which is dedicated to accounting standards and producing financial information, and that's what I do. But that's not what you do in F9. Management accounting, if you're going to make a decision about whether you buy or sell, whether you're going to close down a business, if you're going to make an actual management decision, you look at the management accounts. Yeah? You look at the budgets. Now, management accounts are not constrained by IFRS, because management accounts are for internal consumption purposes only and are not being published. So, the segmental report is management accounts. It will not necessarily have the same policies and the same measurement issues as the financial statements. Measurement. This is one of my problems, or one of my weaknesses, or one of my frustrations. The measurement is per the management accounts. The measurement is per, in accordance with, the management accounts. In other words, it does not have to be IFRS compliant. It does not have to be IFRS compliant. We would allocate common assets, we would allocate common expenses on a reasonable basis. Right, time out, I need to slow down. Segmental reports are management accounting. Management accounting is not regulated, so the information may not be as reliable. When we're looking at preparing segmental reports, we will have problems like, for example, the advertising budget. If you put an advert on the World Wide Web, if you advertise and sponsor the Olympics, If you are Coca-Cola and you are advertising and putting your adverts on the Olympics, the cost of that, how would you allocate the cost of that to Europe, Asia, Africa? Don't know. The standard says you do so on a reasonable basis. But there is scope, enormous scope, for management to slightly manipulate that if they wanted to. I think a reasonable way of allocating an advertising budget may be based on revenue. So if Asia had 10, Africa had 5, and Europe had 20, then I would allocate the revenue in those, I would allocate the advertising costs in those proportions. Yeah? 20 35ths to Europe, 5 35ths to Africa, and 10 35ths to Asia. That would be my gut reaction. Just like if you had head office. And if one of the functions of head office was HR, then you might allocate the cost of head office across the segments on a headcount basis. The more staff you have, the bigger proportion. But the standard doesn't say any of it. It just simply says do it on a reasonable basis. So, management accounts are more, pliable, aren't they, I would suggest. Identification of segments. Identification of segments. How do we identify that we have a segment? You are identifying a segment through the eyes of management. You are identifying the segment through the eyes of management. Because it is as the chief operating decision maker looks at the business. If the company makes decisions on the allocation of resources on a geographical basis, then that's how we identify our segments on a geographical basis. I don't want there to be 35 segments. There's 182 or 200 countries in the world, and I'd imagine Coca-Cola is probably in every one. But you wouldn't want to have 182 segmental reports. It would be ridiculous. So kind of the maximum number, as a rule of thumb, is said to be 10. Materiality is given to us that if a segment is more than 10% of the revenue, it's material. If it's more than 10% of the profit, it's material. Or if it's more than 10% of the assets, it is material. So any segment that has 10% of the revenue, or 10% of the profit, or 10% of the assets should be left alone, should be shown as a separate item. We can combine similar segments. So activities which are deemed to be similar can be combined. You might put the Southeast Asia together on the basis they are similar, Asian and the European Union. You might put the European Union countries together on the basis that they are somehow similar from afar. And how do you evaluate that? What factors would you consider in looking at that combination? So if you're looking to combine, you might want to consider the nature of the product and the nature of the service that is being provided. The nature of the production process.